Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am super thrilled that you're here, and you are going to really enjoy the interview we've got going today. We're interviewing a gentleman named Scott Choppin, and he's the founder of Urban Pacific Group in Long Beach, California. And they are solely developers, but they have developed a lot of stuff. And so we're going to dig into that, and particularly love the fact that it's workforce housing, which this country desperately needs. So welcome to the show, my friend.
Thanks, Rod. Great to be here and appreciate the invite.
Absolutely. No, I'm really looking forward to hearing a little bit about your story. Now, I read that your company has been around since 1960, and you are not 60 years old. I am, and I recognize it. So
right. So the bio talks about that. My family has been in real estate in Long Beach since 1960. So my uncle Mike Choppin formed a real estate development company. So that was his claim. But really, I make that statement to just demonstrate to people that I come from a deep background in the real estate development space. That's really all I've ever done. So, as you mentioned before, pure real estate developer historically and today. Usually I ask the question, how'd you get in the business? But obviously with your Uncle Mike, that's kind of a foregone answer. But maybe you could speak to a little bit how your progress happened. Into this business and maybe how you first got started. A lot of people, that listen haven't taken action yet. And you've got kind of a unique niche in that, most people start out as investors and operators. They don't, they buy existing value add, whatever, and you build it. So can you maybe give us a little bit of background? Sure. No, appreciate the question. So, like lots of kids, when your family is in a certain business, my Uncle Mike was in the business. My dad Kerry was in the business. That was a thing for a while when I was young. I didn't want to do, right? Like, kids do. But I did a couple things, a couple key events happened for me, Rod. So one is after high school, I worked in the construction field for a couple of years. So, I was a guy out working on the site, getting dirty every day. And that taught me ultimately what I didn't want to do, right? And good people, we still work with construction people, daily in building our projects, salt of the earth. But I knew for me, who I was and my personality wasn't going to be satisfied with that. And plus, by the way, it's just hard on your body. It's going to limit the amount of money you can make. So I came to terms with that. Like it was clear to me that there was not a long runway for that space. Although at 19, I was making more money than any of my friends. But the second part of that was that it gave me the opportunity to observe what a project was, like how did it go together, right? Deeply familiar with like just building of, wood frame apartment buildings. In fact, all the projects I worked on in construction were apartment buildings. And I remember one day, nothing to do with, my family, but the real estate developer who was, building the building I worked on rolled up in his nice car, wearing a suit, in those days when people wore suits. And I recognized, I go, okay, I get it now. Like from my family background and knowing what real estate developers did, this was the guy. And I clearly it showed up to me. I go, that's what I want to do. And then the second really key for me was, I'm a voracious reader. I have been my entire life. And at 18, I read, one of the really famous, 1950s era book, how to make $1 million investing in real estate on the weekends, right? One of those, famous books. And what that did for me, Rod, was gave me the picture into deal making, right? What it was to be an entrepreneur in real estate, to find projects. In that instance, it would be, acquiring existing assets. We didn't call it value add in those days, but that's ultimately what it was. And that cemented for me. I go, now I have the background from my family, but the deal making and the creativity and sort of the adventure to a certain degree, I was 18, right? Like it became clear to me. And so really from that time on, like 18, 19 years old, I knew what I wanted to do, and really every step I took from there, the college that I picked, the college major that I picked, the first several companies that I worked for,
what
really
was the
the first
major?
couple companies.
What was
Say
the
again?
major? What was the major?
Oh, yeah. So I worked actually for two companies. One, people know today is KB Home. In the day, it was called Kaufman and Broad. And I worked for a division theirs that was called the Multi-Housing Group. And we were an internal corporate offer, a syndicator and developer of apartment projects for KB or Kaufman and Broad corporate, right? Not a retail offer. Nobody even knew we existed. But I worked there for a guy named Mike Costa, incredible real estate development talent. Basically, started my career there. And then later I went for a little while to a company called, I worked with a company called Saris Regis Group, which is a well-known real estate development company based here in Orange County. And it was after Saris that I left and formed what is now Urban Pacific Group. And that's been 20 years in operations, in fact, this year.
No kidding. And so at a high level, describe your, and maybe, is the business model you started with the same thing that you're doing now?
It is different, but there are common themes. And
all right, well, talk about how you started then. What did you start doing 20 years ago as Urban Pacific, and then let's work forward if you don't mind.
Yeah, absolutely. So when I worked for Saris Regis Group, good group of guys, very talented. I worked for a guy named Jeff Stack there, and Jeff at the time with his partners was investigating. This was 1999. Where do we go, right? Looking forward in the future. And they hired a company called Robert Charles Lesser and Company, or RCL Co. They're a pretty well-known national market research, market survey firm. And they, at the time, had a guy in Orange County named Bob Gardner, right? Great guy. Bob, I think, is semi-retired now, although I think he's still active. But his whole philosophy was about urban housing. And in 1999 and 2000, living in downtown areas of any big city really wasn't like a popular trend. It was really cutting edge. Right. And love Jeff, good guy, super brilliant talent in the space, but he didn't want to do urban. That wasn't his thing. And it was sort of like the report just didn't really go anywhere. And it was really, I looked at that thing and I go, man, that is really where I want to be working. I was 32 at the time. To me, it resonated. Urban housing, loft housing in places like downtown LA. Man, a lot of energy, a lot of excitement around that space, even if it wasn't popular, right? Mm-hmm. So started the company. In fact, we named Urban Pacific. Really was to pursue urban infill real estate development that would be new construction. We did some adaptive reuse at the time, taking old office buildings and converting them into loft housing. And really, we've been doing that for 20 years. And then really, we morphed into about 3 years ago, focusing entirely on the workforce housing space, which was a move, which we can talk about, to differentiate ourselves. And it really was a combination, Rod, of my background working for Kaufman and Broad. We did affordable housing projects, think Section 42, low-income housing. And then at Saris, I did market rate. So it gave me like a spectrum of product types that I had background in. And ultimately, the UTH, Urban Townhouse model, is a combination of those two, basically pairing private capital with a workforce housing rental model is how we speak it.
Okay. And so speak to what's different about your niche in workforce housing and a normal's the wrong word, an A-class developer that's putting out high-end product. What are some of the differences and nuances, if you could speak to the differences? Sure.
So let me first define what workforce housing means. Mm-hmm. Excuse me, right? So commonly, workforce housing, when people speak about today, is they're talking about a value add. Think a B or C class asset in a B or C neighborhood, which is acquired and maybe rents are maintained for middle income families that live there, right? That would be, I think, the more common definition. For us, workforce housing is a new construction offer, which makes it different. But we're still serving those middle income or moderate income families. Think 80 to 120% of median income, right? But it is new construction. In your Class A luxury, think urban podium type projects. You can have a mix of studio and one bedrooms. classically serving a Gen Z or millennial demographic, right? Largest demographic cohort in U.S. history. Great market to be in. Demographic trends are there for you, those folks that are in their life cycle to move out and occupy units. But we did that product and up to 2016, we did, multiple large institutional grade projects. But in 2016, we really start to get the sense that the market was starting to be overbuilt, right? I mean, 2016 was, 4 years ago. But we saw just little instances of really a lot of supply coming on board in downtown LA, downtown Long Beach. And that gave us the opportunity to start to look around as we do, looking to be contrarian, looking for the uncommon offer. And it was really at that point that we thought, let's look at something that's an alternate product. And with my background that I spoke before of affordable housing and market rate housing, we started to just innovate and riff on the idea of serving the middle income population that makes too much money to afford, or too much money, they overqualify for government subsidized housing, but they don't make enough money to afford the Class A luxury, high rent, and particularly small unit product, right? I think our tenant profile is a large, blue collar working family in Southern California, right? Maybe 6 to 8 people in the family. Importantly, 2 to 4 wage earners, what we call a multi-earner household. And they're not going to live in a studio, right? They're not going to live in a 1-bedroom. They are looking for housing that's coherent with their lifestyle, big family. They live in, sort of not suburban neighborhoods, but they're not living in downtown, in the sexy gentrifying neighborhoods. These are working class folks and they live in working class neighborhoods. And so we came up with the idea of UTH, which was to serve this population with a new housing offer. And we came up with this urban townhouse product, which has evolved over the 3 years that we've been really purely executing on that plan. But importantly, we're building a 3-story townhouse rental product with 5 bedrooms and 4 baths, 1,750 square feet. 1,750 square feet and a 2-car direct access ground floor garage. So the way we speak it is this is a rental product that's purposely designed and built to house these families, multi-generational working class families.
1,750 square feet. Did you say 5-bedroom, 4-bath?
Correct.
Wow. And 2-car garage. And so I'm assuming this is on a small footprint since you're going up 3 stories.
Yeah. So great question. So originally the first project we did was a 2-story, 4-bedroom, 3-bath that sort of had a bigger footprint. And as we executed on that project, our first several projects, Rod, were what we call the demonstration phase. Because this product was so experimental, we didn't want to take on a lot of risk of a brand new cutting edge product and not have it go well. So we basically stayed disciplined, had 4 projects in this demonstration phase. The very first one was this 2-story townhouse. Immediately we recognized, we should have shrunk the footprint and go up a story, so that allows us to increase density. So that's exactly the move we made. You called it correctly. And we've really moved forward from that point on with really sticking very closely to the original design of this 3-story townhouse, although we've refined it, over several projects now.
So a couple of questions. So do you find buildings that you raise, or do you find vacant land, infill land, or all the above? And so that's question. First part of the question. Second part of the question is, what are the typical? How many units typically on one of your projects? Is it? I'm just don't want to guess.
Yeah. No, great question. So we do, to answer your first question, we're finding underutilized land assets. So think, classically we find an old, really small house from the 1920s era on a big lot with the right zoning, right? That's the sort of the narrative we have for it. But we do regularly find vacant land. In the infill environment, we find what's available, right? So we're developing an already existing urban fabric. We're not in green fields. So land is where we find it. It's underutilized. We're acquiring a land asset now where the building burned down, right? But had the right zoning. So that's part of the criteria. The other one, though, is for land is we're really looking for land parcels that are in low and moderate income neighborhoods, right? We're not going into the high end. This would be another differentiator to your early question, is the Class A new construction assets would all be, in the highest income neighborhoods you can find land, right? Downtown LA, right? Irvine Business Center would be another location here in Orange County, close by. We're actually going the other direction. We're looking for neighborhoods that are, working class neighborhoods, blue collar, low and moderate income, for a couple of reasons. One is good land purchase prices, right? More competitive land purchase prices.
Niche,
but
right?
Also we buy. Oh, sorry. Oh.
I said that's critical for your niche, right?
Yeah, absolutely. In fact, it's a competitive advantage that we can go into these neighborhoods because we don't have competition. And then the last part of that is, zoning is an easier story, right? We don't have resistant neighbors. We always try to find zone sites when we can. So the second part of your question is a great question also, which is the early phases, the demonstration phase, we stayed, small, right? Medium-sized projects, in the institutional measurement of project sizes.
What does that mean with specificity?
So we're finishing a project right now that's 7 units in Orange County. Our next project after that was 15 units.
Okay.
And then right now we've moved out of the demonstration phase and we're working on a project in El Monte that's 85 units. So right now our spectrum is about 30 to 100 units in the LA Basin, Orange County, Northern Orange County markets, although we have expansion, designed for San Diego, Bay Area, Portland, Seattle, and Denver. We've underwritten projects in all those markets, and this product works feasibility-wise, but also these are, as you would expect, major urban metros with this sort of tenant demographic that needs, moderate income, naturally affordable housing, right? This is a story across the U.S. really.
So which I would guess that makes it easier for you to increase density wherever you can and get through the city and the county because there's such a huge need for this. I don't want to assume, but I'm assuming that's the case. It makes it easier.
Yeah, I love the logic, but we're talking about municipal governments here, and that maybe sometimes works, maybe doesn't. I will tell you this: in California, there's a movement afoot of a lot of particularly younger, millennial, Gen Z generation folks that are really looking at a future of housing costs that is out of reach for them. YIMBYs, they're called, Yes in My Backyard. And they're really making a lot of noise and actually getting some good laws passed and, facilitating the political process, where we're now really in a radically different environment in California. Now, we still are in that push-pull environment where we've got this group pushing for new laws. Of course, the real estate business is itself looking to do that. But then you have an entrenched, population, as you do in almost any city, at least bigger metro areas, that, is resistant to growth. Like, they like it just like it is. And then, by the way, it's human nature, right? As a developer, sure. I've learned that we're a change agent, right? We come into a neighborhood and our job is to make a profitable project for ourselves and investors. And we implement change. That's really fundamentally what we do. And so one of the things we do with UTH, Rod, is we really focus on already zoned sites where we can go in and just do a set of construction drawings and submit straight to plan check and skip any rezoning entirely.
Oh, nice. Well, that makes it a whole lot easier and more scalable for sure. Yeah. One of my questions was going to be, does this only work in California where we know rents are insane? But then you brought up San Diego, of course, Bay Area, no question, Seattle, no question. And then you said Denver, which is where I lived for 30 years. So I know what happened there as well. I used to own 500 houses there, and biggest mistake I ever made in my life was selling those. But incredible opportunity there for sure. No question. I know it well. Went to high school there. But okay. So let me ask you this now. Is your strategy build and hold, or do you ultimately sell? Do you ultimately refinance? Do you hold? I mean, are you building these assets to hold long term? Yeah. And then that'll cue up a second question, which is, do you battle proof them? Do you put in the hard floors? Do you put in the countertops and the counter and the cabinets that are going to last? So 2-part question: you're going to hold them, you sell them, and what do you do to battle proof them?
Yeah, no, spoken as a great multifamily owner yourself, you coming from that, I recognize that place. So yeah, great question. In the beginning, during the demonstration phase, we needed to prove the model, right? We needed to like say it worked economically, feasibility wise. We needed to prove the rents worked. Nobody does 5 bedrooms at scale, right? We needed to know we could build it, right? What are the construction costs? We were in a rising construction cost environment for, a decade plus. And then really any apartment deal maker, the most important thing is what's its value at sale or what's its value at refinance, right? So the first 3 projects we sold, those were all in Long Beach. Did great, raised capital, paid back the investors within a couple of years, produced a 22.6 IRR across that 3 apartment deal portfolio. And then the 4th project is in Fullerton, the one I mentioned previously. And we like the model now so much, Rod, that we're going to hold it forever, right? That's the narrative we have. And of course, we need to be coherent with the capital markets. We raise capital predominantly from high net worth individuals and family offices. This really isn't an institutional product yet. We need to scale it more, I think, for the equity checks to get big enough for that. And we have relationships there and we'll move that way. But right now it's those other folks that I mentioned. And so, yeah, then the question becomes, how do we build the projects differently now that we long-term hold? So now every project we do from Fullerton, Montebello, El Monte that I've all mentioned, we're going to hold all of those long term. And so we orient a little bit differently, but honestly, Rod, only a couple key places, right? Everything would basically have been a generally good apartment grade build specification no matter what. So we're doing, a production style cabinet. But it's a decent product. We make it locally here. So we take the China supply chains out of play here. We got a cabinet shop locally that we give them all of our work, and he's able to produce at volumes that we need that are sufficient to supply the units that we're building. Nice, product, self closers. We use quartz countertops, and then we have this epoxy base vinyl plank that we use throughout, and that's really the predominance of all the living areas, hallways. Entry halls all have this, this vinyl plank flooring. And then on our early projects, we were doing carpet in the bedrooms. And we're going to move away from that now. So I think in our Montebello project, which is under construction now, we're going to keep that. So I think we'll do all the vinyl plank throughout, kitchens, bathrooms, hallways, bedrooms. But it really the product we're using looks like a relatively real wood floor. And then the beauty of it with this resin base, it's not a wood base with a, vinyl on top. It's this resin. So, I mean, you can abuse that stuff all day long. Yeah. And, it's going to be robust. Really, they call it waterproof is how the flooring companies. Other than that, that's really the only changes. Really? Appliance packages would be similar. We're doing a mid-grade appliance package, but everything else, these are all have heating and cooling. We do an orange peel spec on the drywall. We're in California, so a lot of our specs are like higher than other states. So energy efficiency, Title 24. We're using 5/8 drywall throughout. The framing is beefier because guess what? We're in California with the seismic. So that just is a natural sort of process that we're doing. And then this year, lucky for us, we get to install solar in every unit. That's now a mandate from the state of California.
Wow. So that lends my next question, which is how do you accomplish this at a cost per square foot, including the land and the construction? So let me ask you this question. What is the cost per square foot just for what's above the ground, for the construction, in the product that you're doing right now? Now, I anticipate it's going to go down with what's happening in the environment, but what has it been?
Yeah. So the way I'll speak it is we're right now at about $130 a square foot net leasable, but that's not just for the building. That's all in. So that's utilities in the street, which, we don't do a lot, but
that's
we do
the land?
occasionally. Huh?
That's the land too?
Oh, not sorry. That's all the construction, site work,
okay, but the
utilities, and
impact
hard
fee,
cost of building.
Okay, gotcha.
So that's $1.30, and you're right on the money. We're already seeing signals in the subcontract markets that those prices are coming down. So we just bought out the stucco contract on our Montebello project, 25% savings like immediately.
Wow.
And that's, for two reasons, which we're already seeing immediate effects, is a lot of additional labor now coming into the marketplace during the lockdown. Projects are shutting down. And so those that are still active, and construction is considered essential in California.
Right.
We're very lucky that way. So we've been able to continue under construction. Not all cities are staying open. Some have closed, right? So you can't get inspections. We've been fortunate that all of our active projects are open. But I will tell you, Rod, for the last year and a half, we really haven't acquired much because land was getting too expensive and construction costs were rising. And we were just not, like, the returns were just not getting us excited. So we sort of naturally ramped down anyways. And, of course, like you guys, we were like 10-year economic expansion, longest in U.S. history. You and I went through 2008, we start to look for the signals and go, it's coming. Yep. We don't know when, we don't know what will trigger it, but let's be disciplined. Let's not have a boatload of, product that we got to lease up if the market turns against us. So we naturally sort of pared down. And then also that gave us, part of the reason we went to the long-term hold was, in anticipation of a downturn, we saw how apartment communities performed in the 08-09 recession in Southern California. And unless they had debt distress or just owner distress because they couldn't manage it correctly, a well-run, with good maturity length and the future dates for their financing, did fine, right? In fact, they very stable, occupancies, stable rental revenues. And so we really took a lesson from that and just said, look, that's the product we want to be in. So, we used to do for sale, condo. We stopped doing that, and at 2008 after we got out of that market. But, not because we didn't like that space, although we don't like it, but more we just firmly believe that the rental story, particularly in markets like California, is so strong that there's no reason for us to be doing anything but that. So, converting to a long-term hold was really defensive from a recession also.
And what do you buy that someone else pays off, right? I mean, that's
Where do you reinvest? That's, better than, and we're not like, we're not drinking our own Kool-Aid, by the way, of saying only our product, but, we are able to develop at values. Really, the way I think of it, Rada, is when you're a developer, you should be developing at costs below values, right? It's the opposite of below replacement costs. And now in this recessionary environment, we'll start to look at assets that are priced, below replacement costs, right? Distressed assets. If it costs you $100K a door to build, you should be buying at 80. We're not there yet. We're early in the cycle for that to show up.
We've got some under contract that fit that bill right now, actually. But
right.
There are going to be a lot more of them for sure. Now, I would guess that you have no trouble filling your units like that. Am I right? I mean,
yeah, you are. In fact, we before the recession, to the 2020 recession, the move we were making was really an affordability move. In other words, these families occupied our units because we were a lower cost alternative for them to rent. But more importantly, these are multi-earner households, right? So 6 to 8 people, 2 to 4 wage earners. And what that does is it gives them a very stable stance in the marketplace, right? So if you got 4 wage earners, if one person or 2 people lose their jobs, it doesn't destroy the income stream for the family. In fact, I call it the economic sharing model, which amongst the family group, they're sharing incomes and expenses across the larger family group with multi-earners, right? And that we saw in 2008. And then we saw, really from our experience, in this space, for many, many years, that these families they're working class families. They want to maintain, a good life for their family. They have strong social networks. Their kids are in school. Their church is down the road. Their extended family lives, around where they are living now. All we're doing is giving them a space to move into that's coherent with their larger family lifestyle, right? So they may be living in two bedrooms that are close by or side by side. we're pulling them out of those units into ours, what we call recombination. Really, it's a combining of a family group together. And these are related families, mind you, although there is a roommate story here as well. So, now today in May of 2020, this recombination economic sharing model is perfectly situated for now what's happening, which is layoffs are hurting single earner households that may be living on their own or maybe with one roommate. They're challenged when they lose their job to maintain the occupancy in that unit. And so you're seeing that product be challenged, right? Think like, workforce housing, BC, value add, 1 bedrooms, right? That's going to be challenging. So we'll class A, studios and ones as an example. And where are they going? They're going into larger units. And that's right, the space that we're occupying. But also, interestingly enough, in the coronavirus era, a couple of things. Our density allows every unit has its own front door, right? No common hallways, no elevators, no entry lobbies. You walk out your front door and you're out in the outdoors. And then 2 is these 5 bedrooms. What we're seeing is people will be occupying 4 bedrooms, and they're going to keep that 5th bedroom to work at home. Mm-hmm, sure. Or like we had one family that had 2 college students, and that was going to be their study room. So we're seeing some interesting dynamics now that we didn't anticipate, right? The work at home movement, and particularly for it to be so like radically changing, so quickly changing.
Yeah. Zoom went from 10 million users a day to 300 million. I mean, it's happening right now. And I interviewed a doctor, and he said it's a new normal. Now, let me ask you this, just satisfy my own curiosity. You've got a 2-car garage. You've got a 5-bedroom townhouse. Is the garage the ground floor, and then there's a stairway up the side then? So the first living floor is above the garage?
So the way I described it, so on the ground floor of your 3 floors, you got a 2-car garage, and then you have an entry foyer, front door, and then on all of our units, one of the bedroom bathroom combos is on the ground floor to make it truly multi-generational, right? So grandparents, grandmother, grandfather, elder in-laws, anybody who had mobility issues are going to be in that space, although that would be the home office for some people that choose that. Then you go up a set of stairs. Middle floor would be a big combined kitchen, dining, living. We do kitchen island. We got the quartz countertops. So it's a good, space for a family of this. And then another bedroom, bathroom on that floor. And then you go up another stairs to the 3rd floor. And then you have 3 bedrooms and 2 bathrooms on that top floor, one of which is the master, has an ensuite bathroom with that, in combination with that bedroom.
Got it. Wow. Fascinating. I'd love to see the floor plan for that. It sounds fascinating. So it's about 1,700. So what is it per floor then?
So the 1,750, great question. The 1,750 does not include the garage. So if you added 400 to that unit, 1,750 plus 400, divide that by 3.
So 750-ish a floor. Got it.
Our bedrooms, we'll have, the master's 12 by 12, right? With the ensuite bathroom. So it's decent size. Now, some people go, wow, that must be a lot of small bedrooms. And they're really not. I mean, we have, our average is 10 to 10 by 10, 10 by 11, right? We try to do cantilevers to expand the bedroom space where we can. Right? I mean, we've refined these unit plans, Rod, to the nth degree. We've built them, several projects. We're continuing to refine it, remove the complexity, tune up the specs. So we're just production-oriented housing. And this is the most production-oriented I've ever been in my career, which, I'm loving in this time. We're all about removing complexity from the development process in any way.
Well, especially right now, because the opportunity is coming for you, for sure. I mean, there's going to be incredible opportunities for your niche, no question. Well, listen, Scott, I really appreciate your valuable time. Fascinating business model. Urban Pacific Group is the name of his company. Thank you so much for sharing your story, my friend. Really, really very enlightening.
Thank you, Rod. Appreciate the opportunity.
All right. Take care, buddy. Thanks.
All right.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet.
Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.